Last week I told you to mark a date on your calendar. I said watch what the Fed does, then come back and see if it was noise or something bigger. Today we're doing exactly that, and there is one number from this decision that almost nobody is talking about, SCHD has mentioned yet. The 30-year Treasury yield just hit its highest level since 2007. Sit with that for a second. Not since before the financial crisis has long-term borrowing been this expensive. And it happened on the same day the Fed chose to hold rates steady. That is the real story here, not the headline. Everyone else is repeating. Before anything else, this video is for education only. I'm not a licensed financial advisor. All data is from public sources. Please check the numbers yourself and talk to a qualified professional about your own situation. Here is what happened. The Fed did not raise rates. They held steady. But this was not a quiet, boring hold. 3 Fed officials pushed hard for a hike and lost the vote. That kind of open disagreement inside the Fed is rare, and it tells you the data itself is genuinely split. Not that anyone is hiding bad news. A Fed willing to argue in public is actually healthier than a Fed pretending to agree when it does not. So if you held SCHD through this, your dividend stream did not take the hit some people were bracing for. But do not relax yet because the market itself did not celebrate. Stocks dipped after the announcement instead of rallying, and long-term yields kept climbing, capped off by the 30-year yield hitting a level not seen in almost 2 decades. That combination, a Fed holding steady while long-term yields keep rising anyway, tells you investors are not convinced the pressure is over. They're simply pricing in that it may show up later instead of right now. Let's talk about why rising long-term yields matter more for SCHD than the Fed's own short-term rate. Here's the part most channels skip. The Fed controls short-term rates directly, but it does not control the 30-year yield. That number moves on its own, driven by how much investors demand to lock up money for decades. When that yield climbs to a level like this on its own, without the Fed even moving, it means the bond market is doing some of the Fed's tightening work for it. For dividend funds like SCHD, that matters just as much as anything the Fed itself decides, because it changes what a safe long-term return looks like compared to your dividend yield. Now, here is where it gets real for your wallet. Remember the 2 holdings I flagged last time as running tighter than usual on cash flow? Rising long-term borrowing costs are exactly the kind of pressure that keeps sitting on companies like that instead of easing off quickly. This does not mean a dividend cut is coming. It means the companies already being tested are still being tested, and the environment around them just got a little more expensive to operate in. But here's the encouraging news, and this is the part that should actually make you feel better about holding SCHD for the long run. The fund absorbed a genuinely split, uncertain Fed decision and a multi-decade high in long-term yields on the very same day without any drama in its own dividend stream. No cuts, no emergency headlines, just the same quiet, unglamorous behavior that built a 14-year growth streak in the first place. That behavior is the whole point. SCHD was never designed to be exciting. It was designed to keep paying you while everyone else argues about what happens next. Let's zoom out for a moment because this is not a one-meeting story anymore. Every future Fed meeting from here forward is now a genuine watch point, and so is the bond market itself, not just Washington. That gives you something valuable most investors will waste. Time to prepare instead of react. You already know which 2 holdings inside SCHD carry the most pressure right now. You already know a rate decision does not automatically force a dividend cut. And now you know that long-term yields, not just the Fed's own rate, are the quieter signal actually worth watching. Think about how many times this exact pattern is played out. A divided Fed, rising long-term yields, weeks of nervous headlines, and then once the dust settles, the same dividend funds everyone worried about are still standing, still paying, still climbing. That pattern has repeated across cycle after cycle, yet a fresh wave of investors panics every single time like it is happening for the first time. Do not be a part of that wave. Be the person who watches the fund and the bond market instead of the headline. Here is a mistake I want to help you avoid. Do not let a split decision and a scary-sounding yield headline turn into weeks of anxious price checking. That is exactly the trap that turns calm long-term investors into nervous short-term traders. The habit that actually protects your money is boring on purpose. Check your dividend payout dates. Check whether guidance changes on the 2 companies I flagged. Ignore the daily price swings because those swings are noise dressed up as information. This is also where most content creators get it wrong. They chase the headline number, the one that changes every single day, instead of the pattern underneath it. SCHD was not built around predicting any single Fed meeting correctly. It was built around a screening process tough enough that the underlying companies keep paying no matter which way that meeting goes. The difference, focusing on the process instead of the prediction, is the entire reason some investors stay calm through cycles like this while others sell at exactly the wrong moment. Let's put a number on this so it feels real. If you're holding a position in SCHD worth $50,000, roughly 40% of that sits with the top 10 holdings. A stretch of higher long-term borrowing costs means the slice stays under a slightly longer spotlight. But the other 60% spread across 90 more companies just keeps collecting cash flow in the background the same way it always has. That is not luck. That is diversification working exactly the way it is supposed to. So here is the honest bottom line for anyone still holding SCHD after this week. Nothing broke. Nothing needs fixing. But the story is not fully closed either, because both the Fed's next move and the bond market's own behavior are still very much in play. If you understand that today, you're already ahead of most investors who will only start paying attention once headlines get loud again. Here's your next action step. Do not wait for the next Fed meeting to catch you off guard. Write down the 2 holdings I flagged, watch their next earnings report, and keep half an eye on long-term Treasury yields alongside the Fed's own decisions. You will know exactly whether the pressure is easing or building before anyone else does. That single habit is the difference between an investor who reacts to headlines and an investor who reads the story before it is written. If this kind of follow-through is what you want more of, then hit subscribe. We do not just call the story before it happens. We come back and tell you what it actually meant. That is the difference between a channel chasing clicks and a channel actually trying to make you a better, calmer investor. We'll see you in the next one.